Right now, as you're watching this, the largest transfer of wealth in human history is already underway. We're talking about $84 trillion changing hands over the next 2 decades. That's not a typo. $84 trillion. To put that in perspective, that's more than the entire GDP of the United States, China, and Japan combined. And here's what almost nobody is telling you. Where that money flows next will determine who builds generational wealth and who gets left behind holding depreciating paper. The baby boomer generation, the wealthiest cohort to ever walk this planet, is beginning the largest asset handoff in recorded history. But here's where it gets interesting. This isn't just about inheritance checks landing in bank accounts. This is about a fundamental shift in how wealth is stored, protected, and transferred. And the smart money, the institutional players who move markets, they're already positioning for what comes next. Let me show you what's really happening behind the curtain, because the mainstream financial media is missing the biggest story of our generation. The boomers accumulated their wealth during a very specific period in history. They bought homes when a single income could support a family. They invested in stocks during the greatest bull market ever seen. They benefited from pension plans that don't exist anymore. They lived through an era when the dollar was backed by something real, then watched as it became pure fiat currency in 1971. And now, as they prepare to pass this wealth down, something fascinating is occurring. Central banks around the world are buying gold at a pace we haven't seen since 1967. Let that sink in. The very institutions that print money, that control monetary policy, that tell you inflation is transitory, they're converting their reserves into physical gold at record levels. In the past 2 years alone, central banks have purchased over 2,000 tons of gold. That's not normal accumulation. That's preparation. The People's Bank of China has been buying gold for 17 consecutive months. The Reserve Bank of India just added another 27 tons to their reserves. Poland, Singapore, Turkey, they're all loading up. These aren't random decisions. These are coordinated moves by institutions that understand something the average investor doesn't. The greatest wealth transfer in history is happening during the greatest monetary experiment in history. Think about what that means. The generation receiving this wealth, millennials and Gen X, they're inheriting dollars, stocks, bonds, and real estate during a time when the purchasing power of those assets is being systematically eroded. The Federal Reserve has expanded the money supply by over 40% since 2020. That's not economic growth, that's currency debasement. And the people who understand this are converting paper wealth into hard assets before the transfer is complete. Here's a story that illustrates exactly what I'm talking about. In 2008, during the financial crisis, a wealthy family in Connecticut had accumulated roughly $12 million in various assets: real estate, stocks, bonds, cash, traditional wealth. The patriarch of the family, a successful businessman who'd built his fortune over 4 decades, watched as his stock portfolio lost 40% of its value in 6 months. His real estate holdings became illiquid. Banks that he'd trusted for years needed government bailouts to survive, and in that moment, he made a decision that would change his family's financial future forever. He converted 30% of his liquid assets into physical gold and silver. Not ETFs, not mining stocks, physical metal that he could hold. His children thought he'd lost his mind. His financial advisor warned him about opportunity cost. His friends at the country club called it a panic move. But he understood something they didn't. He'd lived through the 1970s. He remembered when gold went from $35 an ounce to $850. He understood that when the system breaks, you want to own things that can't be printed, can't be hacked, and can't be devalued by central bank policy. By 2011, that 30% allocation had more than doubled in value, while his stock portfolio was still recovering. But here's the really interesting part. When he passed away in 2019, his estate planning attorney discovered something remarkable. The physical gold and silver he'd purchased had not only preserved wealth through the crisis, it had created a tax-efficient transfer mechanism for his heirs. The stepped-up basis meant his children inherited those assets at current market value, avoiding capital gains on the appreciation. And because it was physical metal, not paper contracts, there was no counterparty risk, no brokerage fees, no management expenses eating away at the inheritance. That family understood what's happening right now on a global scale. The wealth transfer isn't just about moving money from one generation to another. It's about converting that wealth into assets that will survive what's coming next. Let me show you the mechanics of what's actually happening in the gold market right now, because this is where it gets really interesting. The COMEX, the primary exchange where gold futures are traded, is showing signs of stress that veteran traders haven't seen in decades. The ratio of paper gold to physical gold has exploded. We're talking about 100 ounces of paper claims for every single ounce of physical metal available for delivery. Think about what that means. If even 2% of the people holding paper gold contracts decided they wanted physical delivery, the entire system would collapse. It's a fractional reserve system applied to precious metals. And just like fractional reserve banking, it works perfectly until everyone wants their money at the same time. The London Bullion Market Association, the LBMA, which handles the majority of global gold trading, recently had to change their delivery rules. They extended settlement times. They allowed for cash settlement instead of physical delivery. These aren't normal operational adjustments. These are emergency measures to prevent a squeeze that could send prices parabolic. And here's where the wealth transfer story intersects with the gold story in a way that should make every investor pay attention. The generation inheriting this wealth, they're digital natives. They understand technology. They've watched Bitcoin go from zero to $1 trillion asset class. They've seen how quickly markets can move in the information age, and many of them are looking at their parents' traditional portfolios and asking a very simple question: why would I want to hold assets that can be inflated away? There's a quiet revolution happening in wealth management right now. High net worth families are restructuring their estates before the transfer happens. They're converting portions of their portfolios into hard assets. They're setting up trusts that hold physical precious metals. They're creating multi-generational wealth preservation strategies that don't rely on the continued stability of fiat currency. I spoke with an estate planning attorney in New York who specializes in high net worth families. She told me something that should concern every financial advisor in America. Over the past 3 years, she's seen a 300% increase in clients requesting gold and silver allocations within their estate plans. These aren't conspiracy theorists or doomsday preppers. These are families with $50 million, $100 million, $500 million in assets, old money, generational wealth, and they're moving portions of their estates into physical precious metals before passing them to the next generation. Why? Because they understand history. They know that every fiat currency in history has eventually failed. The Roman denarius, the French assignat, the German Papiermark, the Zimbabwean dollar. The average lifespan of a fiat currency is 27 years. The US dollar has been a pure fiat currency since 1971. Do the math. Now, here's something practical that might be relevant to your situation. If you're sitting on retirement accounts worth $100,000 or more, there's a structure called a gold IRA that allows you to hold physical precious metals inside your retirement account without triggering tax penalties. I put together a free guide that explains exactly how this works, the rules around it, and how to evaluate if it makes sense for your situation. It's in the description below. No obligation, just information. Worth checking out if you're thinking about how to protect wealth during this transfer period. All right, back to what's happening in the markets right now, because the timing of this wealth transfer couldn't be more critical. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several new members, are actively working to create an alternative to the dollar-based financial system. They're not hiding this. They're announcing it at summits. They're signing bilateral trade agreements that bypass the dollar. They're settling oil transactions in yuan. They're building payment systems that don't route through SWIFT. And at the center of this de-dollarization movement is gold. The BRICS nations have been accumulating gold reserves at an accelerating pace. China alone is estimated to hold far more gold than they officially report. Russia has been converting dollar reserves into gold for years. India's citizens hold more gold than any other country on Earth. This isn't coincidental. This is strategic positioning for a new monetary system. Here's what this means for the wealth transfer. The generation receiving these trillions in assets is inheriting them at a moment when the global monetary system is being restructured. The Bretton Woods system that established dollar dominance after World War II is breaking down. The petrodollar system that reinforced that dominance is crumbling. And the new system being built by half the world's population is gold-centric. Let me give you a specific example of how this is playing out. In 2022, Russia was hit with unprecedented financial sanctions. Their dollar reserves were frozen. Their access to SWIFT was cut off. Their ability to participate in the Western financial system was eliminated overnight. But here's what didn't get frozen: their gold reserves. Physical gold held in Russian vaults couldn't be sanctioned. It couldn't be seized. It couldn't be devalued by decree. And Russia continued to trade, continued to function, continued to operate, because they had real assets that the world still wanted. That lesson wasn't lost on other nations. Saudi Arabia, which has backed the dollar for 50 years through the petrodollar agreement, is now accepting yuan for oil sales. They're in talks to join BRICS. They're diversifying their reserves away from dollars and into gold. The United Arab Emirates just opened a gold trading hub in Dubai that's processing billions in transactions outside the Western banking system. These are tectonic shifts in the global financial architecture. And the wealthy families managing the greatest wealth transfer in history, they're watching this unfold in real time. They're asking themselves, do I want to pass down wealth denominated in a currency that's losing its global reserve status? Or do I want to pass down assets that have been money for 5,000 years? The supply and demand dynamics in the physical gold market are reaching a critical point. Global gold production peaked in 2018. We're not finding new deposits at the rate we're mining existing ones. Meanwhile, demand from central banks, from Asian consumers, from institutional investors is at all-time highs. The World Gold Council reports that investment demand for gold bars and coins increased 28% year over year. ETF holdings are growing, sovereign wealth funds are allocating, and the paper market is getting stretched thinner and thinner. There's a concept in markets called a short squeeze. It happens when too many people are betting against an asset, and when the price starts rising, they're forced to buy to cover their positions, which drives the price even higher. We're seeing the setup for a short squeeze in gold, but it's not traditional short sellers who are exposed. It's the entire fractional reserve system of paper gold contracts. It's the bullion banks that have sold claims on metal they don't have. It's the ETFs that hold paper promises instead of physical bars. When that squeeze happens, and I'm not saying if, I'm saying when, because the math doesn't work any other way, the price discovery mechanism is going to break. We're going to see the kind of price moves that seem impossible until they happen. And the people holding physical metal are going to be on the right side of the greatest wealth preservation trade in modern history. Let me tell you about what happened in 1980, because history doesn't repeat, but it often rhymes. Gold had been climbing steadily through the 1970s as inflation ravaged the dollar. It went from $35 an ounce in 1971 to $200 by 1974. Then it consolidated for a few years. People thought the move was over. Financial advisors told clients to sell and get back into stocks. And then, in 1979, something broke. The Soviet Union invaded Afghanistan. The Iranian Revolution disrupted oil supplies. Inflation hit 13%. The dollar was in free fall, and gold went from $200 to $850 in less than a year. That's a 325% move in 12 months. People who had sold in 1975 watched in horror as the metal they'd given up on went parabolic. People who had held through the consolidation, who had understood that the fundamentals hadn't changed, they made generational wealth. We're in a similar setup right now. Gold has been consolidating in a range while the fundamentals have been building. The money supply has exploded. Debt levels are at historic highs. Geopolitical tensions are escalating. The dollar's reserve status is being challenged. And the wealthy families managing the greatest wealth transfer in history are quietly accumulating physical metal before the next leg up. Here's something most people don't understand about how the ultra-wealthy think about assets. They don't chase returns. They preserve purchasing power across generations. A family with $100 million doesn't need to make 20% a year. They need to make sure that $100 million can still buy $100 million worth of goods and services in 20 years. That's a completely different investment philosophy than what most financial advisors teach. And when you think about wealth preservation across generations, gold makes perfect sense. It's the only asset that has maintained its purchasing power for thousands of years. An ounce of gold bought a fine suit in Roman times. It buys a fine suit today. That's not true of any fiat currency. The dollar has lost 98% of its purchasing power since 1913. The British pound has lost 99%. Every paper currency eventually trends toward its intrinsic value, zero. The families transferring wealth right now understand this. They've seen currencies come and go. They've watched empires rise and fall. They've studied history. And they know that the one constant, the one asset that has survived every monetary crisis, every war, every revolution, is gold. There's a reason why central banks hold gold. It's not because they're sentimental. It's not because they don't understand modern finance. It's because gold is the ultimate reserve asset. It's the asset of last resort. It's what backs the system when everything else fails. And if central banks are accumulating gold at record levels while telling the public that inflation is under control and the economy is strong, what does that tell you about what they really think is coming? The commercial banks are showing interesting positioning too. The big bullion banks, JP Morgan, HSBC, Goldman Sachs, they've been accumulating physical gold in their vaults while maintaining short positions in the paper market. That's a very specific strategy. They're hedging the paper system while accumulating the physical metal. They're preparing for a scenario where paper and physical prices diverge, where the futures market becomes irrelevant and only physical metal matters. This is exactly what happened in the silver market in 2021. The paper price and the physical price separated. You could see silver quoted at $25 on the COMEX, while physical dealers were charging $35 for actual coins and bars. That spread, that disconnect between paper and physical, that's what happens when a fractional reserve system breaks down. And it's coming to gold. The wealth transfer is accelerating this process. As trillions of dollars move from boomers to their heirs, a portion of that wealth is being converted into physical assets. Not all of it. Maybe 5%, maybe 10%. But when you're talking about $84 trillion, even 5% is over $4 trillion. That's more than the entire annual gold mining production for the next 50 years. The market can't absorb that kind of demand without a massive price adjustment. And here's the really interesting part. The generation receiving this wealth, they're not just buying gold as an investment. They're buying it as insurance. They're buying it as a hedge against the monetary system. They're buying it because they don't trust the institutions their parents trusted. They watched the 2008 financial crisis. They saw the bank bailouts. They lived through the pandemic money printing. They understand that the system is fragile in ways previous generations didn't fully appreciate. There's a psychological shift happening that's just as important as the financial shift. The social contract between citizens and their government, between savers and their banks, between investors and the financial system, that contract is breaking down. Trust is eroding. And when trust erodes, people move their wealth into assets that don't require trust, assets that have intrinsic value, assets that can't be manipulated by policy decisions. Gold is the ultimate trustless asset. You don't need to trust a government to maintain its value. You don't need to trust a bank to honor its obligations. You don't need to trust a corporation to manage it properly. You hold it, you own it, and its value is recognized globally without any intermediary. That's incredibly powerful in a world where institutional trust is collapsing. The estate planning strategies being implemented right now reflect this shift. Families are setting up structures that allow them to hold physical gold outside the banking system. They're using allocated storage in jurisdictions with strong property rights. They're creating trusts that can hold precious metals for multiple generations. They're thinking about wealth preservation in terms of decades and centuries, not quarters and years. I want you to think about your own situation for a moment. If you're expecting to receive an inheritance or if you're planning to leave one, have you thought about how that wealth will be structured? Have you considered what assets will actually preserve purchasing power over the next 20, 30, 40 years? Have you looked at what the ultra-wealthy are doing with their estates? Because here's what they're doing. They're diversifying out of paper assets and into hard assets. They're reducing their exposure to the banking system. They're holding physical precious metals in secure storage. They're creating multi-generational wealth preservation strategies that don't depend on the continued stability of any single currency or government. This isn't doom and gloom. This is prudent wealth management. This is what smart money has always done during periods of monetary transition. And we are absolutely in a period of monetary transition right now. The system that's existed since 1971, pure fiat currency backed by nothing but government decree, that system is being stress tested in ways it's never been tested before. The debt levels are unsustainable. The U.S. national debt is over $36 trillion and growing by $1 trillion every 100 days. That debt can never be repaid in today's dollars. It can only be inflated away. And when you inflate away debt, you inflate away savings. You inflate away purchasing power. You inflate away the wealth that's being transferred from one generation to the next, unless that wealth is held in assets that can't be inflated. Assets like gold, assets like silver, assets that have intrinsic value independent of government policy. The greatest wealth transfer in history is happening right now. The question isn't whether it's happening. The question is, what form will that wealth take when it reaches the next generation? Will it be dollars that have lost half their purchasing power? Will it be stocks trading at valuations that only make sense in a zero-interest rate environment? Will it be bonds that get crushed when rates rise? Or will it be real assets, hard assets, assets that have preserved wealth through every crisis in human history? The smart money has already made their decision. Central banks have made their decision. The ultra-wealthy families managing generational wealth have made their decision. They're converting paper into metal. They're moving wealth out of the system and into assets the system can't control. And they're doing it quietly, before the crowd figures out what's happening. Because once the crowd figures it out, once the average investor realizes that the emperor has no clothes, that the monetary system is built on confidence and nothing else, the rush into hard assets will be unlike anything we've seen before. The setup is there. The fundamentals are there. The geopolitical catalysts are there. The monetary policy mistakes are there. Everything is in place for the next major move in gold, and it's happening during the greatest wealth transfer in history. That's not a coincidence. That's the market telling you something. The question is, are you listening?